Welcome to our first lecture on risk. When we talk about risk, we are facing the uncertainty of possible future events, together with the uncertainty of the outcome of such happenings. In an attempt to define what risk is, we talk about fortuity. That means unpredictability, or the uncertainty of a loss occurring. In insurance and in risk management, we tend to use the word risk as opposed to chance, since risk denotes that something negative might occur as opposed to chance, wherein we are referring to the possibility of a favorable outcome. There are different types of risk. A few of them are mentioned in this slide. For example, physical, the tangible risks, technological, economic risks, social risks, political risks influenced by the government, environmental risks, and legal risks. As we said before, risk is the uncertainty. However, we can define various levels of risk and also determine the respective causes. For example, we measure risk by frequency and severity. These are the two main measures of risk. As you can see from the slide, frequency and severity can be plotted, and through this graph we can then relate the different outcomes of frequency and severity. That is, high frequency, low severity, low frequency, high severity, high frequency, high severity, low frequency, low severity. The peril is the prime cause of a loss, and the word hazard means that influences the outcome. That means that makes the risk more probable or less probable to occur, is therefore called the hazard, which can be physical due to the nature of the risk itself, and moral, which relates to the human behavior and characteristics. Risk can be classified into financial and non-financial, pure and speculative, fundamental and particular. Financial, of course, denotes that the risk can be measured financially as opposed to non-financial risks. Pure risk can be at best break-even, or else can be one which outcome is negative, as opposed to speculative, which can produce a favorable outcome. On the other hand, a risk can be fundamental, that means affecting a widespread range of events, or particular, that means related to a particular individual. In an attempt to try and control risk, we look at a process known as risk management. Risk management is therefore the way risks are identified, analyzed, and eventually managed, controlled. We are here looking at risks which can threaten the assets or profitability of an organization. Next, we discuss the basics of insurance. Insurance is a way of how risks are transferred from an individual or an organization to an insurer. The insurer pools risks into a fund from which money can be paid out to those suffering an unfortunate loss. Different premiums are collected according to the different types of risks. Insurance is important because it generates certain confidence when it comes to investment, it helps the society, and also it helps the individual to take certain risks.